Your W2 is not a paycheck. It is a pre-configured extraction mechanism, engineered by the tax code to capture your maximum economic output before you ever see a single dollar. Here is the uncomfortable arithmetic. A corporate woman earning $180,000 annually in a high-cost state like California or New York is not operating in a 32% bracket. She is absorbing federal income tax, FICA contributions, state income tax, and Medicare surtax simultaneously. Her blended effective extraction rate lands between 38% and 42%. That means nearly 4 out of every $10 she earns never belong to her. This is not a tax bracket problem. It is a structural design problem. The W2 compensation model was architecturally built for one purpose: maximum revenue extraction at the source. The IRS collects before you allocate, before you invest, before you build. You receive what is left after the system has already taken its position. If you receive the same code with the W2 compensation model, and here's the data point most six-figure earners have never stress-tested. The Tax Policy Center confirmed that W-2 employees are statistically the most heavily taxed economic class in the United States, paying higher effective rates than pass-through business owners, real estate operators, and capital asset holders at equivalent income levels. You are not being taxed because you earn well. You are being taxed at maximum efficiency because your income is the most legible, the most traceable, and the most structurally exposed category of earnings in the entire tax architecture. That distinction is the entire game. The compounding damage is not the tax rate itself. It is the sequence. W-2 income is taxed pre-allocation, meaning you have zero leverage to redirect capital before the government claims its position. A business owner with equivalent gross revenue makes structural decisions on pre-tax dollars. You are making investment and lifestyle decisions on post-tax dollars. That asymmetry, sustained over a decade, is the precise mechanism separating a $900,000 net worth from a $2.4 million net worth at identical gross income levels. Run the math directly. Two professionals both earn $180,000 gross annually. The W2 executive nets approximately $107,000 after blended taxes. The S-Corporation operator routing identical revenue through a reasonable salary plus distribution structure legitimately retains closer to $128,000 to $133,000 after optimized self-employment and income tax treatment. That gap is $21,000 to $26,000 per year. Invested at a conservative 7% annualized return over 20 years, that differential compounds to between $400,000 and $500,000 in net wealth. Not from earning more. From the same gross income. Restructured. This is where the hidden psychological architecture of the W-2 trap becomes dangerous. Because the system feels safe. The automatic withholding, the clean pay stub, the employer-managed benefits, these are compliance comforts designed to remove your financial agency without triggering alarm. Corporate infrastructure removes the friction of tax management, and in doing so, it removes your decision-making power entirely. Pause on that. The most sophisticated tax reduction strategies are all predicated on one non-negotiable condition: pre-tax capital control. W-2 earners structurally lack it. The second layer of extraction is FICA. You are paying 7.65% in FICA taxes on every dollar up to $184,500, and your employer matches it. That match is not a benefit to you. It is compensation that never reaches your paycheck, pre-allocated back into a system delivering Social Security returns that trail private market index fund performance by a historically documented margin. The Urban Institute's long-term benefit analysis confirms that a 40-year-old high-income W-2 earner today will receive Social Security returns below what passive index investing of equivalent contributions would have generated. You are paying a mandatory premium into an underperforming vehicle, with no opt-out, no portability, and no compounding benefit to your personal balance sheet. The third extraction layer is the one most senior executives never see: the phantom loss of deductibility. Business operators deduct healthcare premiums, home office infrastructure, professional development, business travel, and technology as pre-tax operational expenses. As a W-2 employee, these same categories, which you are absolutely incurring to sustain a six-figure corporate career, are either non-deductible or subject to the 2% AGI floor that effectively eliminated most miscellaneous itemized deductions under the 2017 Tax Cuts and Jobs Act. The system simultaneously extracts at the front and forecloses deduction at the back. That is a two-wall enclosure. Here is the structural revelation. The single most powerful, legally defensible, and IRS-compliant strategy available to a high-earning professional woman transitioning out of pure W-2 dependency is what institutional tax planners call the bifurcated income architecture. The bifurcated income architecture is not tax evasion. It is not an offshore scheme. It is the deliberate, IRS-sanctioned separation of your total economic output into two legally distinct income streams: earned compensation and business-derived distribution, each governed by a different tax treatment under the Internal Revenue Code. The execution model is precise. If you carry any monetizable expertise, consulting, advising, board service, coaching, content, or speaking, you establish an S-corporation entity. You pay yourself a reasonable salary, as defined by IRS guidelines, typically 40% to 60% of net profit. The remaining profit distributes as shareholder distributions, which are not subject to self-employment tax or FICA. That immediate structural shift eliminates 15.3% self-employment tax on your distributed income, combined with a solo 401k contribution, allowing up to $72,000 annually in pre-tax retirement contributions as both employer and employee, and Section 199A's qualified business income deduction, offering up to 20% deduction on pass-through income, 1898. ND. New lunch products, as both employer and income deduction. Income, the bifurcated income architecture, systematically dismantles every layer of the W-2 extraction sequence simultaneously. This is not a workaround. Congress architected these provisions deliberately into the tax code. The gap is not illegal, it is intentional, and it favors those with the structural sophistication to access it. The architectural integrity of your financial life cannot be built on a foundation that another institution controls. Pre-allocation. Your net worth trajectory is a direct mathematical output of when in the income sequence you gain capital control. The women compounding wealth at scale are not earning more. They're capturing the same dollars at an earlier point in the extraction chain. The bifurcated income architecture solves your personal tax bleed, but it only addresses the wealth you are generating today. The more unsettling question is what happens to the wealth you accumulate after the restructuring is complete. Because here is the systemic reality most high-earning women never encounter until it is structurally too late. Individual wealth, no matter how precisely built, is still subject to estate erosion, generational delusion, and institutional recapture, unless it is moved into a completely different legal architecture altogether. The families sitting on multi-generational wealth are not simply investing well. They are operating inside a trust and entity structure specifically engineered to make wealth inheritance frictionless, tax-shielded, and legally untouchable across generations, a system that never got a public press release. The same tax code creating your W-2 trap is the same code that has allowed dynastic capital to compound, shielded from estate tax, capital gains realization, and public disclosure for over a century. Click the video on your screen right now, and let's pull back the next layer. to dissect exactly how generational wealth architectures legally sidestep the same tax system that is systematically extracting yours.